Hello, friends. If you are 65 or older, or you will turn 65 in the next few months, there are 5 bills you may be legally exempt from paying right now. And the number that should stop you is this. One of these bills alone can cost a person $67,800 over 10 years, for a premium that should have been zero the entire time. That is real money, exposed to a rule that already exists, going uncollected because nobody told the person it was theirs. These are not proposals. They are not rumors. They are current exemptions sitting in 5 different systems, and not one of them activates automatically. The people who stop paying are not luckier. They just found out first. Hello, friends. Here is what we are covering today. There are 5 separate bill categories that can shrink or disappear entirely once you cross the age 65 line. Some are federal, some are state, some are buried inside your city utility bill. That is exactly why people miss them, because no single office handles all 5, and not one of them turns on by itself. Grab a pen, write down the ones that apply to you, because I can tell you right now, at least one of these is yours. And by the end, you will know exactly where to call, exactly what to say, and exactly what form to file. These thresholds, premiums, and filing rules change every single year. The people subscribed here hear about them before the money slips away, not after. If that sounds like something you want, subscribe now and let's get into it. Before we go further, I need to address something, because people hear a topic like this and immediately sort themselves into one of 2 groups. The first group is the comfortable retiree. Some savings, maybe a paid-off home, maybe still pulling in investment income. And you figure this kind of thing is for people in worse shape than you are. You hear bills you can stop paying and think, that's not me. The second group is living on a fixed income. You count every dollar. And you have learned, through experience, that the good programs are always for somebody else. There is always a catch, and you always seem to fall on the wrong side of it. Both of those assumptions are wrong about at least one of the items I am covering today. And on every single one, I will tell you exactly which group it helps most and why. Some of these will surprise the comfortable group. Some will surprise the fixed income group. And the last one is the annual bill people overpay in silence, the federal tax return itself. Stay with me to the end for that one. Now let's get into it. Number 1, your Medicare Part A premium. Here is the misconception. A lot of people who delay Social Security assume that because they are not collecting benefits yet, they have to pay for Part A, the hospital insurance side of Medicare. They see the bill, they pay the bill, and they never question it. That assumption can cost a fortune. Here is how it actually works. Medicare Part A is premium-free for anyone who has at least 40 quarters of Medicare-covered employment. That is roughly 10 years of work. And here's the part most people miss. It does not have to be your work record. If your spouse has at least 40 quarters, you can qualify for premium-free Part A through their record, even if you never worked enough quarters yourself. About 99% of Medicare beneficiaries pay zero for Part A. But the ones who do not qualify and have fewer than 30 quarters of coverage are paying the full 2026 buy-in premium of $565 a month. If you have at least 30 quarters, or you are married to someone who does, the 2026 reduced premium is $311 a month. Now here is the math that matters. $565 every single month. That is $6,780 a year. Over 10 years, that is $67,800 gone for a bill that many people should never have been paying in the first place. Even at the reduced level, $311 a month is $3,732 a year. Over 10 years, $37,320. Who does this help most? Both groups. This is not income tested. The comfortable retiree is often the surprise here because they delayed Social Security, assumed that meant Part A had to be purchased, and never checked the spouse rule. And some fixed income viewers are actually paying a buy-in premium right now that their own work history should have eliminated years ago. A man I heard from said he had delayed Social Security and assumed that meant he had to keep paying for Part A. James, 66, retired truck dispatcher outside Toledo, Ohio. He had been paying the $311 reduced Part A premium every month, even though his wife's work record made him eligible for premium-free Part A. Nobody told him. The bill just kept coming. The fix was one call to Social Security. He confirmed premium-free eligibility based on his spouse's record. $311 a month. $3,732 a year. Gone. Here is your action step. Check whether you qualify for premium-free Part A based on your own record or your spouse's. Go to ssa.gov, the Medicare sign-up page, or call 1-800-772-1213. If you are not already on Social Security, do this around the turning 65 window. The Social Security Administration says to sign up 3 months before your 65th birthday. And if you are already over 65 when you apply, know that Part A can be backdated up to 6 months, which can create a tax issue if you have a health savings account. Ask about that when you call. Use the exact words, "I'm 65 and I want to confirm whether I qualify for premium-free Medicare Part A based on my work record or my spouse's." That is number one, and it can be worth tens of thousands. The next one is smaller month to month, but it is the kind of bill people keep paying every week because nobody ever handed them the right card. Number two, the full transit fare you are still paying after 65. Here is the misconception. People assume the senior fare just starts automatically when you get older. You turn 65, the system knows, and the fare drops. It does not work that way. The reduced fare or ride-free benefit is almost always a separate application that nobody sends you. Here is how it actually works. In New York, the MTA's reduced fare program is for senior citizens 65 years or older. It pays half fare on New York City Transit subways and local buses and other listed services. But you have to apply for it separately. In Chicago, the CTA says Illinois residents 65 or older who are enrolled in the state's Benefit Access Program are eligible for free transit on CTA, Metra, and PACE fixed routes. Not reduced, free. But that program has income limits. For 2026, those are $33,562 for a one-person household, $44,533 for two, and $55,500 for three. And the enrollment lasts 2 years before you need to refile. None of this is automatic. The transit agency does not mail you a senior card just because you had a birthday. Now the dollar math. Take the CTA train fare as a clean example. Full fare is $2.50 a ride. Reduced fare is $1.25. If you ride 40 times a month, that is $100 at full price and $50 at reduced fare. That is $50 saved every month. Over a year, $600. Over 5 years, $3,000. And if the ride-free program applies to you, the savings on that same 40-ride pattern is $100 a month, $1,200 a year, and $6,000 over 5 years. Who does this help most? Fixed income viewers. If you ride transit regularly and you are counting every dollar, this is real weekly money back. But it is not always a poverty program. The MTA's reduced fare in New York is age-based with no income limit at all. Here is your action step. Call your local transit authority and ask one question. Do you have a senior fare or ride-free program that starts at 65? And what exactly do I need to file to activate it? In Illinois, call the senior helpline at 1-800-252-8966 for the benefit access application. In New York, go to the MTA's Senior Reduced Fare application page or call 1-877-323-7433. That is number 2. Transit is where the overpayment is visible. Property tax is where it gets buried. Number 3, your property tax. Now, everything I have covered so far might sound like help for people in obvious need. A Medicare premium fix. A transit card. Practical, yes, but maybe you are thinking this is aimed at a certain kind of senior. I need you to hear this one carefully, because this is where a paid-off homeowner can be overpaying just as quietly. Here is the misconception. Most people assume property tax relief is only for seniors in very deep financial trouble. It is not. Some of it is income tested, yes, but some of it is purely age-triggered, with no income limit at all. And the reason people miss it is simple. The county or state usually waits for you to ask. Here is how quietly it goes unclaimed. According to AARP, more than 9 million Americans likely qualify for property tax relief, but only about 8% apply. 8%. That means for every one person collecting, roughly 12 are paying full price for no reason other than they never filed. Let me walk through 3 states so you can see the pattern. In Pennsylvania, the Property Tax Rent Rebate Program gives seniors 65 and older with household income of $48,110 or less a rebate of $380 to $1,000, with a supplemental rebate that can push the total to $1,500 a year. The application form is the PA 1000, or you can file through MyPath online. The deadline for rebates on 2025 property tax is December 31st, 2026. In Texas, when you turn 65, you become eligible for an additional school district homestead exemption of $60,000 on top of the general $140,000 residence homestead exemption. Local taxing units may offer at least $3,000 more. That exemption is effective January 1st of the tax year you turn 65. No income limit. The form is 50-114, filed with your local appraisal district, generally between January 1st and April 30th. In Florida, there are local option exemptions for homeowners 65 and older that can reach up to $50,000 of assessed value. The homestead application is due March 1st. Florida's income threshold for the 65-plus local option exemption is 2026 household income limit for Florida, DR 501 SC. Now, the dollar math. Even using just the Pennsylvania rebate as the clean example, that is up to $1,000 a year, and in some cases $1,500. Over 10 years, that is $10,000 to $15,000. And the Texas exemption is not a rebate at all. It is a reduction in the taxable value of your home, which lowers the bill every single year as long as you live there. Who does this help most? Both groups. The rebate side helps fixed income viewers most. But here's the surprise for the comfortable group. The Texas-style age-only homestead exemption has no income limit. If you own your home and you turned 65, you likely qualify. And many homeowners with paid-off houses and healthy savings never bother to check because they assume this kind of program is not for them. It is. A woman I heard from in Pennsylvania thought this was a poverty program and not a senior program. Eileen, 74, retired school secretary, Scranton, Pennsylvania. Her income was under the lowest band. She qualified for the standard rebate and the supplement. She had been paying her property taxes in full every year and never filed because she assumed it was for someone in worse shape. She filed the PA 1000. Her rebate came back at $1,500 for the year. $1,500. Sitting there the whole time. Here is your action step. Call your county assessor or your state revenue office and ask 2 questions. Use these exact words. What property tax relief programs start at age 65 in this county, and which of them have no income limit? Deadlines matter here. Pennsylvania is December 31st, 2026. Texas is generally April 30th. Florida is March 1st. If you are reading this and you own your home, make that call this week. That is number 3. That was the county level version. The next one gets even quieter because it can be hiding inside a city utility bill. Number 4. Your city utility and garbage charges. Here is the misconception. If your city offered a senior break on your sewer or garbage bill, it would already be on the bill. The city knows your age. The city sends you the bill. So if the discount were real, it would just show up. That is what most people believe. And it is wrong. Here is how it actually works. Some cities have senior exemptions on sewer charges, garbage fees, or both. But the bill keeps coming at full price until you walk in or call in and file for it yourself. This is the most local item I am covering today, and I want to be clear, not every city has this, but enough do that it is worth one phone call to find out. Chicago is the cleanest example I can give you. The city of Chicago has a senior citizen sewer exemption for residents 65 or over who live in their own home with separate metered water service or a separate city water assessment. When approved, that exemption cuts the eligible senior's total water and sewer bill by 50% by removing the sewer charges, and also cuts the water sewer usage tax by 50%. On top of that, Chicago's residential garbage fee is $9.50 a month per dwelling unit, and eligible seniors receive a 50% discount on that fee. Nobody sends a letter, nobody adjusts the bill. The full charge keeps arriving until you apply. Now, the dollar math. On the garbage line alone, that is $4.75 a month saved, and $57 a year. That sounds small on its own. But the bigger hit is the sewer program, where the water and sewer bill itself can be cut in half. Stack those together, and in a city like Chicago, a qualifying senior is leaving real money on the table every single billing cycle. Who does this help most? Fixed income viewers. If you are on a tight monthly budget and you own your home in a city that offers this kind of exemption, every line on every bill matters. This is the kind of quiet savings that adds up precisely because nobody thinks to look for it. Here is your action step. Call your city's utility billing or finance department and say, "I'm 65 or older, and I want to know whether this city has any sewer, garbage, or utility charge exemptions for owner-occupied senior households." One call. If the program exists, they will tell you what to file. If it does not exist in your city, you have lost nothing but 5 minutes. That is number 4. And the last one is the one people do not think of as a senior benefit at all, even though turning 65 changes the math on the return. Number 5, your federal income tax bill. This is the item I told you to stay for. And here is why it matters. Most people know that turning 65 gives you a slightly larger standard deduction. That has been true for years. What most people do not know is that for tax year 2026, the age 65 tax picture has changed in a way that a lot of preparers are still catching up to. Here is the misconception. The old age 65 addition to the standard deduction is the only tax break that changes when you turn 65. That was mostly true before. It is not true now. Here is how it actually works. Start with the piece people already know. For tax year 2026, if you are 65 or older and unmarried, the additional standard deduction for age is $2,050. If you are married filing jointly, it is $1,650 per qualifying spouse. Now here's the part most people miss. There is a separate temporary senior deduction of $6,000 per eligible individual, effective for tax years 2025 through 2028. If you are married and both of you qualify, that is $12,000. This deduction is available whether you itemize or take the standard deduction. The IRS created a new form to claim it, Schedule 1A, but it phases out. For single filers, the phase-out starts above a modified adjusted gross income of $75,000. For joint filers, $150,000. If you are below those lines, you can likely claim the full amount. Now the dollar math. For one qualifying single senior using the standard deduction in 2026, the combined extra deduction is $6,000 plus $2,050, which is $8,050 removed from taxable income. For a married couple where both are 65 or older, it is $12,000 plus $3,300, which is $15,300. What does that mean in actual tax savings? At a 12% marginal rate, a single senior saves about $966. A married couple saves about $1,836. That is not a refund. That is a reduction in what you owe the federal government. Every single year this provision is in effect. And this provision is not permanent. It runs from 2025 through 2028 under current law. 4 filing seasons. If you miss it, you do not get a second chance on those years. Who does this help most? The comfortable group. This is the direct surprise item for retirees who still have meaningful taxable income and assume there was no extra age 65 tax break beyond the old rules. If your preparer did not know about Schedule 1A, or if you file your own return and never heard of this deduction, you may have already overpaid for 2025. Some fixed income viewers benefit too, but many may owe little or no federal tax in the first place. If that is you, this one may not move the needle. I promised I would be honest about that on every item, and this is where that honesty matters. Here is your action step. Before you file, or before your preparer files, verify that the return includes both the standard age 65 edition and, if you are eligible, the separate senior deduction on Schedule 1A. If you use a preparer, say these words: I turned 65 last year. Did you include both my age 65 deduction and the separate senior deduction on Schedule 1A? If they do not know what Schedule 1A is, that is your answer. That is number 5. So here's the full picture. The Medicare Part A premium that can drop from $311 or $565 a month to zero if your work record or your spouse's record makes you premium free. The full transit fare that can fall to half fare or free once the 65 plus card is actually filed. The property tax relief that can mean $1,000 to $1,500 a year in the worked example, and much more over time. The city utility and garbage charges that in some places can be cut in half once a senior exemption is approved. And the federal tax bill that changes the day you cross into the age 65 deduction rules, with a temporary extra deduction that only runs through 2028. 5 bills, 5 separate systems, and not one of them activates on its own. The Social Security Administration does not call to tell you your Part A should be free. The transit agency does not mail you a senior fare card just because you had a birthday. The county assessor does not assume you want the senior property break. The city utility office does not rewrite your bill on its own. And the IRS does not reach across the desk and ask whether your preparer missed the senior deduction. Being legally entitled to relief and actually receiving it are 2 completely different things. The gap between them is information. Now, I want you to think of one person, a parent, a neighbor, a friend from church who just turned 65 and still pays every bill the same way they did at 64. Share this with them, not because they are struggling, because the odds are very good they are paying at least one of these at full price for no reason other than nobody ever told them where the form was. Subscribe, share this with someone you know who just crossed 65 or is about to, and I'll see you in the next one.